All right, quick gut check before you scroll past this. If you care about where money is actually hiding right now, you need to hear what I'm about to tell you. JPMorgan Chase, one of the most systemically plugged in banks on the entire planet, just walked through a scenario where gold doesn't just grind higher, it explodes toward $8,000 an ounce. Not next week, not tomorrow morning, but sooner than most people think in market time. And here's the wild part. This didn't come from gold bugs sitting in bunkers. It didn't come from doomers predicting the end of everything. It came from JP Morgan. Stay with me because I'm going to show you exactly what triggered this conversation, why it matters right now, and how you can spot this kind of setup again before the headlines catch up. If you're watching this now, you're already ahead of the crowd that'll be scrambling when this goes mainstream. Before I explain what caused this projection, let me teach you something most people completely miss about how markets actually work. Prices don't move because of headlines. That's backward. Headlines follow flows. Think of markets like a crowded theater. Nothing happens for hours. Everyone's sitting there calm, watching the show. Then one row stands up, then another, and suddenly everyone's moving toward the exits at once. Gold works exactly the same way. It's not about fear spikes that come out of nowhere. It's about slow, quiet reallocations that reach a tipping point. When big pools of capital, we're talking pension funds, sovereign wealth, family offices, when they decide something else in their portfolio isn't pulling its weight anymore, they don't send out press releases. They don't ask for permission. They just shift. And that shift is what this entire JP Morgan scenario is really about. It's not prediction. It's observation of what happens when capital changes its mind. So, what does that tell us? It tells us we should be watching flows, not waiting for CNBC to explain it after the fact. Now, here's what's actually happening behind the scenes. JP Morgan didn't come out with some flashy price target and pound the table telling everyone to buy. That's not how serious institutions operate. They ran a conditional model. Translation? They asked themselves a question. What happens if private investors, not governments, not central banks, but private capital, quietly rebalances? Let me break down the sequence they're watching, because this is important. First, bond returns compress while risk stays elevated. You're holding fixed income. You're getting paid less, but the danger of loss hasn't gone away. Second, investors start looking for assets that don't depend on someone else's promise to pay. That's critical. Bonds are promises. Stocks are claims on future earnings. Gold is just gold. Third, and this is where it gets interesting, even a small shift, we're talking single-digit percentages, even just 3 to 5% out of bonds and into gold creates disproportionate demand. Why? Because gold is a tiny market compared to global fixed income. The entire above-ground gold supply is worth maybe 12 trillion. Global bonds? Over 100 trillion. You move even a fraction, and gold's price discovery mechanism goes haywire. Here's what's wild about this whole dynamic. You don't need everyone to believe in gold. You don't need mass panic or people burying coins in their backyards. You just need enough capital to move at the same time. That's the tipping point. That's the theater moment. Now add the secondary confirmation that's happening right alongside this. Central banks haven't stopped buying gold. They've actually accelerated. That matters more than people realize because it removes supply from the open market permanently. These aren't traders flipping positions. These are sovereigns adding to reserves they'll hold for decades. Poland's been buying. China's been buying. Singapore, India, Turkey, the list goes on. When you pull hundreds of tons out of circulation every year and it's not coming back, the float shrinks. Then layer in the convergence proof. Private capital looking for insurance meets official buyers removing supply. That's when price discovery stops being polite. You get gaps. You get repricing events that don't give you a nice entry point. But here's the part that should actually make you nervous, not excited. This isn't being framed as a crisis trade. It's being framed as a normal portfolio adjustment. Read that JP Morgan note again. They're not screaming about dollar collapse or war or anything dramatic. They're talking about asset allocation. That's how big moves start, quietly, rationally. By the time it feels urgent, you're late. Zoom out with me for a second because this pattern isn't new. This is the exact same playbook that played out in the 1970s when inflation eroded bond confidence and gold repriced from $35 to over $800. You saw it again after 2001 when equity risk reset after the dot-com crash and gold began a decade-long climb from under 300 to over 1900. And more recently, after 2020, when monetary expansion forced investors to completely rethink what safe even meant, gold went from 1700 to over 2100 in months. Every single time these conditions align, currency pressure, geopolitical stress, reallocation out of traditional safe assets, gold doesn't inch higher on a nice trend line. It gaps into a new range and stays there. The pattern is consistent. When you look at history, it's not about timing the absolute top. It's about recognizing regime change before it's obvious. That's the skill. In the 70s, people who understood the bond-gold dynamic early didn't need to catch the exact bottom. They just needed to recognize that the rules had changed. Same thing in the 2000s. Same thing in 2020. We might be seeing the same thing now, or we might not, but the setup looks familiar. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this projection be completely wrong? Absolutely. JPMorgan themselves say this isn't their base case. $8,000 is a scenario, not a forecast. It's a what if, not a guarantee. If inflation collapses tomorrow, if bonds suddenly start offering real positive yields again, if geopolitical risk fades and everything calms down, gold loses its urgency fast. It becomes boring again. And no, this is not proof of some secret manipulation or end-of-the-dollar conspiracy narrative. Here's the thing. You don't need a conspiracy. You just need incentives. You need flows and positioning and human behavior. That's it. Focus on what you can actually observe and control. Flows, positioning, how capital is behaving. Not viral takes and doom predictions. The mechanics matter. The narratives are noise. There are probably 3 types of people watching this right now. Let me speak to each of you directly. The first type already owns gold. Maybe you've been stacking for years, and you're feeling validated right now. I get it. Feels good when a major bank confirms what you've been saying. But let me be brutally honest with you. Validation can make you sloppy. It can make you stop watching the data and start just cheering for your position. Don't do that. This JPMorgan scenario doesn't mean you were right about everything. It means conditions might be aligning. Keep watching the data, not the cheerleading. If flows reverse, if central banks slow buying, if real yields spike, be ready to reassess. You're not married to this trade. The second type is skeptical right now, maybe rolling your eyes, thinking this is just more gold bug nonsense. That's actually healthy. Skepticism keeps you sharp. My advice? Don't dismiss this outright. Track it. Watch actual allocations, not price spikes. Are bond funds seeing outflows? Are gold ETFs seeing sustained inflows? Is physical demand rising or falling? You don't have to believe the $8,000 number. Just watch if the mechanism they described starts playing out. If it doesn't, great, you learned something. If it does, you'll see it early. The third type is newer to this. Maybe you're watching because you're trying to understand markets better, and you're wondering if you're already too late. You're not late to understanding, and understanding is what lets you act calmly when everyone else is panicking or FOMOing in. The fact that you're here learning the mechanics means you're building the foundation. That matters more than catching every move. No matter which type you are, the universal principle is exactly the same. Big moves don't announce themselves with fireworks. They build pressure quietly until something breaks loose. Your job is to recognize the pressure, not predict the exact moment it releases. So here's where I personally stand on all this. I'm not all in on gold, and I'm not dismissing this as hype either. I'm watching signals. Let me tell you what I'm actually monitoring day to day. First, I'm watching private allocation data. Are investors actually trimming bond positions? You can see this in fund flows, in ETF movement, in surveys of institutional positioning. If that trend accelerates, it confirms the JPMorgan thesis. If it stalls, it doesn't. Second, I'm watching central bank purchases month to month. Do they slow down or keep accelerating? If they slow, it removes one leg of the demand story. If they accelerate, it tightens supply even more. Third, I'm watching real yields because that's the gravity well for gold. When real yields go negative or stay near zero, gold has no opportunity cost. When they spike, gold struggles. Right now, real yields are compressed. If that changes, everything changes. This JPMorgan scenario wasn't emotional, it was mechanical. They didn't predict the apocalypse. They modeled what happens when investors shift even a small percentage of capital. That's math, not prophecy. The fundamentals aren't screaming collapse right now. They're whispering transition. And if history rhymes even a little bit, assets that look boring today won't feel boring 6 months from now. Here's what I think this really comes down to. The global financial system runs on confidence. Confidence that bonds will hold value. Confidence that currencies will remain stable. Confidence that the system itself won't break. When that confidence stays intact, gold sits quietly in the corner. But when confidence wobbles, even just a bit, gold becomes the asset people remember, exists. And we're in a period where confidence is being tested, not shattered, but tested. Deficits are large. Geopolitical tension is high. Currency volatility is real. Those are facts, not opinions. JP Morgan's model basically says, if enough people decide they want to hedge that uncertainty, the price of the hedge goes up fast, because there's not enough of it to go around. That's supply and demand at its most basic. It's not magic. It's not manipulation. It's mechanics. Now, I'm not saying you should run out and buy gold tomorrow morning. I'm not a financial advisor. This is not financial advice. Do your own research. What I am saying is, you should understand the setup. You should know what signals to watch. You should recognize that when a bank like JP Morgan, which has every incentive to downplay volatility, publishes a scenario this stark, it's worth paying attention to. Not panicking. Paying attention. If you made it this far, you're the kind of person who wants to understand how things work, not just react to headlines. That mentality will serve you incredibly well, not just in this situation, but in every market you'll ever navigate. The people who win long-term aren't the ones with the best hot takes. They're the ones who understand mechanics and watch flows and stay calm when everyone else is losing their minds. So, do me a favor. If this helped you see the bigger picture, share it with someone who's trying to make sense of markets right now. Hit subscribe if you want more breakdowns like this where we cut through the noise and focus on what actually matters. And drop a comment telling me what you're watching right now. Are you tracking gold, bonds, something else entirely? I read every single one. Stay sharp out there. Think critically. Verify everything. And always, always make your own decisions. I'll see you in the next one.